Hello and welcome to SwitzerTV. I'm Peter Switzer. Our program goes out every Monday night on our own YouTube channel. On tonight's show, we look at our high-tech stocks here in Australia called the WAX stocks. That's WiseTech, Afterpay, Altium, Appen and Xero. Are they a screaming buy? We'll ask Mike McCarthy from CMC Markets. And the banks had a bad week last week with ANZ and Westpac reporting pretty badly. NAB was a bit better than expected, but still wasn't what you might call an exciting story. Are the banks a buy at this particular level in the market? We're going to ask Charlie Aiken from Aiken Investment Management and our own Paul Rickard from the Switzer Report. And if you're thinking about going long gold, have a look at my discussion with the Perth Mint's Jordan Alicio. And finally, Fidelity's Catherine Yung gives you the best argument for investing in China and Asia generally. This bull market has given us birth to unusual stocks out of America called FANG, Facebook, Apple, Amazon, Netflix and Google. And in Australia, we sort of followed suit with WAX stocks, and that is WiseTech, Appen, Altium, give me Macca, last day. Afterpay.
Afterpay, right.
Afterpay and Xero. So these stocks have gone up, but they've recently come off the boil. Is it a buying opportunity? Macca, what do you think?
Case by case, Peter.
Okay,
I want to be
we'll
very careful about that.
Okay.
So let's start at the end, Xero. Now, I really like Xero, and they are global leaders in cloud-based accounting software.
Yep.
And they've really stolen a march. They've penetrated the US market. They're looking very good. The problem for me is the share price.
That's right. This is the best understandable business amongst all those, isn't it? Xero
Absolutely.
is. But I had a quick look. According to FN Arena, the analysts think that the price should be $66, but it's currently $76, a 13% fall they would expect.
Well, and today, Peter, we saw a rejection. It traded up to $77.75 and it closed closer to $75. And that's generally a short-term bad news sign. And I'd much rather buy it around $60 if I got that chance. Love the business. Don't like the share price.
Macca, I did the MC job in the second year for Xero, and the share price then was $14. I brought them on the show, talking about an interesting company, and I didn't buy it $14. I hate myself for that, because I could see it was going to work. The thing that staggered me was, in the audience, it wasn't share investors, it was bookkeepers who had switched from MYOB to Xero. Wow. I thought that was a pretty strong lead. And why I didn't stick with it is beyond me.
We're all geniuses with hindsight, Peter.
We are. All right, let's go to the next one, Afterpay.
Now, this one I don't like, Peter.
No.
And one of the problems I think with Afterpay is the low barriers to entry for competition. We've already seen it. You know, Zip's already in there, and they're a listed group as well. Even old school consumer lenders like Latitude, which is the old Genworth, the old GE company, you know, they've opened up Latitude Pay. And that's the challenge. Now, Afterpay have done very well, and they've got first mover advantage. But I noticed last week they were hit hard when Zip announced its deal with Amazon.
Yeah.
Now,
it's a good thing for Zip.
Very good thing for Zip. Interestingly, they gave up options over about 1.2% of the company to Amazon as part of the deal. So I think they did everything they could to get in that door, but of course Amazon's got the reach that could serve them. And I think that's the big challenge for Afterpay now, is maintaining its first mover advantage. Yeah. I'm not a keen buyer here. I'd rather see it down around $20 to $22. Okay,
and the analyst think it's got 12.7% upside from where it currently is. Right. But I do think this is a real 50-50 stock, and could go up, it could go down. And the developments overseas could be critically important, couldn't they? Because they are making encroachments in the US. And when their share price was rising, it was on the back of better than expected market share in the US. But we haven't heard much about that lately.
No, that's all gone a bit quiet, Peter. And of course, these are still eye-watering multiples. So, and it's the same with all of these stocks, Peter. The right time to buy them is when they're unloved.
Let's go to Altium now, Mike.
Very interesting business, and not one I personally understand that well. This is online software for designers of electronic devices, and they can collaborate, they can draw down on other work that's already in that system. So what's really attractive about it is it's highly scalable, and so I'm keen on the idea, even though it's not a business that does a lot for me. I'm a bit agnostic on it, given that it's middling share price.
Yeah, the analyst think it's got 1.2% upside, so they pretty well think it's fair value, don't they?
That sounds.
I've got to say, Roger Montgomery many years ago put me onto Altium, and he made the point that it's basically the little boards inside computers and all that sort of stuff. They work on that sort of thing. I didn't understand it, but certainly it became a darling. Another one that I missed, which I hate to admit. I must be a dinosaur missing out on these fantastic tech stocks. Okay, Appen.
Appen, this one I really like, Peter. This is automated language technology, and they've got a couple of different businesses coming out of it. One is generating the language for various voice-based applications that are transmitted digitally, and the other is helping with understanding language from a machine point of view. So once again, a very scalable business, and I really like the way this share price has pulled back, Peter. Back from $38, currently around $32. I think this one's right in the sweet spot.
Yeah, well, and the analysts think it's got 33.4% upside. So even if they're half right, I'd be quite happy.
I hate it when I agree with analysts. It worries me. It worries me.
All right, so putting it all together then. WiseTech, that's right. Now, what's the one? Now, WiseTech has got clobbered. It was once regarded as a fantastic company where all logistics trucking companies in the world would have to use their stuff.
Yep.
And then it went off the boil. So explain why it went off the boil.
So we had a short sellers report about 2 weeks ago,
Yep.
and this short seller has a position, let's face it. So the research, the report that they published was exactly in line with their thinking on the stock. They don't like it.
Yeah.
They point to what they call accounting irregularities. They also suggest that there's real problems in an integration of all the bits and pieces that WiseTech have picked up over the years, bringing them together and making them work together.
Because there are a lot of acquisitions, is that what you're saying?
That's right.
Yep.
And so they based this on anecdotal evidence. They interviewed 6 customers. Well, that's not a very strong survey in my mind. And I like this business. I think it's very got real application because it's going into a space where there is very little digital technology. Plenty of warehouses are digitised, but it's that delivery chain and that last couple of kilometres that is open play. And for mine, WiseTech are well into that space and have got a big jump that it's going to take a lot.
How well has management responded to the short sellers' accusations?
Well. And look, they pointed out something we should all know. Accounting standards vary around the world, and there are different ways to treat different items. Now, the company has, I believe, put in place a reasonable defence for the way they treat it. There's plenty of room for opinion on it, but it doesn't mean they're wrong. And what we've seen in the stock since that is a real arm wrestle. On the day after it started trading again, after the company responded the second time, it fell as low as $24.30, but it also rose over $29 in the same day. Now, since then, there's been a real arm wrestle in the stock, but the bulls are winning. Currently $27 today after falling 50 cents. I like the look of this one at the current share price.
All right, Mako, I guess for a person who can't be sure, what if someone just simply decided to play the whack stocks? There's 5 stocks in there, isn't there? 1, 2, 3, 4, 5. Divide they've got $20,000, $4,000 on each. How dumb or how smart a play would that be, do you think?
Well, that'd be a safer way to do it, Peter. We've noticed how volatile these stocks are. But, anybody considering that should be aware that their portfolio could move up and down in value very sharply. But if they're prepared to take that diversified approach, I mean, the reason, Peter, we see such volatility is there's uncertainty about the future of these business models. It's likely at least one will fail. It's likely, in my view, that another one will do stonkingly well and perhaps become another CSL. So a portfolio approach would mean catching that big winner at some cost.
Yeah, and I guess when it comes to something like WiseTech, it is a speculative play, but if they pulled it off, it could be something that could be a real, as you say, a CSL.
Oh, absolutely. I think at the moment Xero's got everything priced in.
Yeah.
I think at the moment WiseTech has got a lot of potential problems priced in. So I'd rather buy the one where the share price is recognising potential problems.
So if you go through the whole 5 of those, is Appen the one you prefer the most?
That'd be my top pick, Appen, then WiseTech.
And that's the one with the analysts believe there's 33 upside. 33% upside. Gee.
I hate going with consensus, but I just hate going with consensus, but in this case I'll just have to wear it.
And we should make the point that last time Michael was on the program, he didn't turn up last week, so I'm sure he was drinking too much on Melbourne Cup Day, or planning
studying the form, Peter, studying the form.
Studying the form. But he did tip Pilgrim Minerals very, very strongly, and it rose 16% over the week, and also Challenger, and what else you're boasting
Platinum
about?
Asset Management.
Yes, another
They're
one.
the winner. There have been losers too, Peter, but those have performed very well for me.
Great. Michael McCarthy from CNC Markets. Well, the banks have not been impressing the market lately, despite a reasonably good day today. But what's behind the banks, and should we trust that the kind of share price we're seeing now and the kind of dividend yield they've been paying can be sustained? To answer that question, we have two brilliant bank experts in Charlie Aiken from Aiken Investment Management and Paul Rickard. I'm not being cynical in saying brilliant bank experts. It is a stock that guys like you have to know, isn't it? Because you're in the market. If you saw it good value, you'd have to play the banks, wouldn't you, Charlie?
Yes, but at the moment I own no banks anywhere in the world because of ultra low interest rates and margin compression and a few headwinds they're fighting. Look, I mean, it's Australian banks you need a view on though, right? I mean, if you have Australian equities, you need a view on them. They're 30% of the market, they're prime suppliers of credit to the economy, and you have to have a view on them. And quite frankly, last week was not a good session for Australian banks.
Was Westpac's report worse than you would have expected?
Yeah, a little bit. Personally, I think there's headwinds in Australian banking that are just not going away. Be they regulatory, be they low interest rates, be they competition, be fintech just chipping away. I think like the last 5 years, Australian banks have actually lost you capital as an investor, but paid you dividends and franking credits. And if you assume that they're going to pay you dividends and franking credits, that's fine. But I would not be setting myself up to hope for capital growth when EPS is going backwards and internal returns are actually going down. But the dividends I do think are broadly sustainable.
Paul?
I think Charlie's being a little negative, but
I am because I don't think they've been great results.
They haven't been great results. They've been underperformers. Although we've got Commonwealth Bank back above $80, so a lot of this does get a little overblown. I mean, I think there are some headwinds. There's no doubt about it. The disappointing part about last week's results was I thought the bank would have made more progress in cutting costs. Yeah. ANZ in particular, I thought was a shocker. Right, this was the bank that set itself up to actually take a nail to its business and get its cost base, and its cost went up. Westpac hadn't done much either, so that does show that it's pretty hard, and that's ultimately what the banks need to do, because the headwinds of balance sheets aren't growing, right? We know that. In fact, if anything, they went backwards a little bit on assets. Margins are still coming under pressure. That ain't going away in the short term. Probably come under a bit more pressure. So the only option a bank has, if to grow its earnings, it either has to cut costs or find new revenue sources. It's really hard to find new revenue sources for banking at the moment. So it's largely about a cost story and managing the risk. And that was a disappointing part of the results last week.
The only thing that worries me here is this reminds me of a conversation we could have had on Telstra 3 years ago.
It does, yeah.
No revenue growth opportunities, got to take costs out. Dividends, the one thing people are attracted to. Dividend, not quite sustainable, but not the end of the world. Share price going backwards. I don't think it's quite the same as Telstra, but there's some similar feeling for me.
Yeah, and Telstra, I take the point. Telstra has rebounded a little bit. So I think banks face challenges, right? But that being said, when you still probably can lock in a 5% yield, right, and you can even factor that down to the years out, that's still very attractive. So they do face. You're right, Charlie. There are similarities with the Telstra story. Although I think the inertia. Telstra never had the dominant position of the four major banks. It did as a single supplier, but the four banks.
The only thing I'll say is that it is hard to cost cut yourself to greatness.
It is.
It is much harder. Right? So,
but it is. But the whole salary structure of banks has to change, right? I mean, one of the things that banks are still operating are hundreds of branches, right, for a world that's now digital.
Yeah, it's true.
Right. So, and they're also, bankers are still really well paid. It's not just the top people. What we're seeing with bankers, if you look at the numbers, it's middle management. There are far too many people in these banks earning pretty good salaries. So the whole cost base has got to come down. It's just not about cost cutting, but that's what you'd like to see more of. So,
Paul, one thing ANZ showed, and this kind of surprised me, that the number of loans they extinguished were actually greater than the loans they created. Now,
they really mishandled the whole credit crisis. So when APRA put the screws on, ANZ particularly got it wrong, right? So I mean, I think, anyways, the CEO of ANZ is lucky to still be there, right? ANZ really mishandled that, not as badly as some of the other two banks did. And so all the mortgage books, Westpac went down in the fourth quarter. NAB also didn't make a lot of headway. So you're right, there's not a lot of balance growth, but
You wouldn't want to see that quarter on quarter.
No, you wouldn't want to see
you'd want to hope
quarter.
that's an aberration
Yeah.
for a variety of reasons.
Yeah, and probably the house price recovery is going to
You
help.
want to make
There's
sure
gonna
that doesn't happen.
Yeah, that's right.
It's not in
So
there.
I think to sort of where we're heading here, Peter, I mean, the good news about last week is that Westpac got the capital issue out of the way.
Yeah.
Right? Now, it came up with a very gloomy outlook story. I'm not sure why its outlook was so gloomy. If anything, what it said
Let's hope
wasn't
it's
that
not the
much
truth.
difference than the other two banks. But
Yeah.
I think it got sandwiched between a bad ANZ result, expecting NAB to be dreadful as well. NAB wasn't as bad as the market expected, as it turned out. And Westpac had to find a reason for the capital. So it's out of the way with the capital side. The capital overhanger is still an issue for ANZ. It's not going away. So this whole thing with New Zealand is going to be up there. It's going to put a pressure on.
Explain the New Zealand for people who don't know.
Well, the Reserve Bank of New Zealand, which is the equivalent of our APRA, not the Reserve Bank of Australia, their regulator is still the central bank is still the regulator of both from a prudential sense and also controls the cash rate in the economy. It wants to see sort of segregated capital. So it wants the Australian banks dominate the New Zealand banking scene. So it wants the Australian banks to actually set aside capital
New Zealand.
for New Zealand,
Yeah.
which means they can't use the capital for any other part of their business at a much higher level than APRA wants.
But this is the
So-
biggest negative argument with the banks, is that the return on capital they're making will never be the same, right, due to regulatory change. So that's what everyone's got to get through their head. The days of 18% ROEs and things, they're behind us, particularly in the low interest
and they've
rate
lost
environment.
businesses that
Correct.
could have made money
So
at
they've sold all
times.
the high earning businesses
Yeah.
like asset managers and things. So these are really mortgage banks that are having to hold more regulatory capital, and the return on that capital is less. Now that's okay if we all acknowledge that. Probably means the PE comes down a bit, as it has a little bit. But we need to be aware that the days of glorious growth for this sector are behind us.
Yeah.
And this is a grind now. You've got to take costs out.
Yeah.
You're fighting regulatory change. You're fighting higher capital requirements. You can still arguably maintain these dividends, but it's going to be a little bit like Westpac for investors. Here's your dividend, but we need a bit more capital.
Yeah.
So we'll still give you the dividend and the franking credits, but we're going to need a little bit of top up.
Well,
of capital.
can I ask
it's going to be a bit of a grind, is my
Yeah, Paul-
view.
and Paul-
Doesn't mean it's the end of the world.
No, but you're basically saying banks have to become old-fashioned bankers. Why are other banks reluctant to lend to business? Because a whole lot of non-banks have taken that space and they're charging unbelievably high interest rates.
I think they are paying the cost from being so badly beaten up, they got scared. And I think that's what last year's little mini credit crisis with APRA shows you. That in APRA's changes were only largely in the mortgage market, particularly around things like principal interest and serviceability ratios, and the banks just rolled over. No one took them on.
Yeah.
And ANZ admits its processing time on a loan went out to something like 28 days, So no wonder they couldn't lend any money if it's going
And
to take
non-banks will take no
non-banks,
business.
right?
Yeah.
So the banks are scared. Now they have to find their ticker a little bit and, be responsible lenders in inverted commas, meet all the tests, but also get a loan out there. So the opportunity is still in the business market, and maybe that's what NAB's showing, that it actually didn't get as badly hit as the other two, as at least ANZ and Westpac did. So, look, the opportunity is still there, Peter, and in the business market, they've just got to start to manage the whole credit application, the nimbleness stuff. But
But they've got to be careful with this, because the generation younger than us, I don't believe they've got any loyalty to any incumbent Australian bank. So if they
Yeah,
work
no
out
loyalty
these-
to anyone,
well,
even their
let-
parents.
Let alone Australia. But if they work out that there's other lenders that they can get money from,
Called a wing-wing lender.
whatever they are, but it is interesting. The banks have got to be careful that they don't scare off the next generation of customer by being too reluctant to lend or having too high barriers to lend. Right?
Well,
So-
story today, Judo Bank, which is a small business bank, basically came out and said, well, the banks are just giving small business to flick. We'll lend to
I
them.
think that's unfair. I mean, it's targeting a very select market. So they're going to get cherry-picked in particular areas, right? And I think Judo's an example of that, and a couple that I'm associated with examples, right?
Athena Banking.
So they're
home
going
loans.
to get cherry-picked, right? And so that's where they need to be careful. And that's why, I mean, I agree with cutting is, very few businesses cut their cost. There's no such glory in being cutting costs, but they have incredibly expensive structures, right? You cannot substantiate. You need a branch every place to cater for a small port of the population who doesn't pay.
You don't even need
So
branches.
they've got to take that challenge by the head. They've got to look at their own internal costs. So, I mean, look at the average bank. Bankers are really well paid. Not talking about CEOs here. I'm talking about average middle executives in banks. They are really well paid.
A lot of them are our fans. They hate you.
Look, when I started in banking, bankers weren't well paid. Today, they are overpaid. So the whole cost structure is
Paul's
still
still got
wrong.
his combat
right?
cardigan.
So I'd like to go back to the cardigan and the name tag, Charlie, of
But
course.
it is. But all you're saying, do you think that the current leaders of the big four banks in Australia realise the urgency or have the ability to deliver the change that's required? And I reckon the answer is no. Absolutely no.
I think possibly 2 do, and maybe 3 do. I think we've got to give them a little more time.
Where's the evidence?
Well,
what are they doing?
I think the challenge challenge at the moment is that when you've got the they've been so tied up in regulatory pressure and having to meet remediation, whatever that is,
and the media pressure linked to that.
And the media pressure, right? So they've got to sort of take that challenge on and say that's enough.
Okay.
We've done remediation.
Right. Okay.
We've done compliance. We need less compliance people.
Paul,
we need to move on. And think about our shareholders.
Rank the banks. If someone hasn't got exposure to the banks, which ones would you?
Oh, come on, who in Australia hasn't got exposure to a bank? Now,
Well,
that's an invisible.
Young investors.
I wrote
Our cameraman probably hasn't got
probably
exposure.
does.
I wrote a brilliant report in today's Switzer Super Report, which
Good
ranks
report.
the 3 that reported last week.
Okay,
Right?
yeah.
Look, there's not much between them, right? I put ANZ at the bottom simply because it's got the capital challenge above it, and we'll probably have to raise capital. That'll depress share prices, right? NAB, if you want more exposure to business banking, you probably go for NAB.
It's the same share price it was 20 years ago.
I'd probably go for Westpac because it was at a premium to the others. It's now at a discount. I still think CBA is probably the best, but there's not much difference. So look, I mean, it's.
Okay.
I think National Australia Bank, new CEO coming, that's a positive, but new CEOs tend to get, the process for a new CEO is to find your way, cut a whole lot of staff, reorganise. That process takes some time.
Yeah.
So,
Charlie, your stand up then?
I just think if you don't own them, you don't need to at the moment.
Yeah.
I think you can just, if you don't own Australian banks, that's not a crime at the moment. I think there are headwinds that are not going away in the short term, and I think that the dividend yields will hang around and give the stocks support so they won't fall apart. But I just think there's no great rush at the moment. No. And I just think there's other sectors and stocks where you can probably generate better total returns over the next year.
Thank you, guys.
So just to find that argument up, because I've got to get in the last.
Yeah, I know.
I don't love banks, right? I don't disagree with all the challenges, but the Westpac share purchase plan, which is going to be at $25.32, no higher. It's a yield of, worst case yield of 6.32%, right? Yeah. They've cut the dividend. The dividend looks secure. It's fully franked. It's hard for a retail investor to say no to that, right?
So if you haven't got a bank share, Paul's basically saying Westpac's probably the best one to go
the
for.
SPP, which you need to be a shareholder.
Okay, that's right. And we're not giving you financial advice.
We're not giving you.
It's just financial education.
Just brilliant education.
Okay. Thank you, Paul Ricard and Charlie Aiken from Aiken Investment Management. Jordan, thanks for joining us.
Thanks for having me, Peter.
So the Perth Mint, everyone's ever, I think, heard about the Perth Mint, but who actually owns it?
Perth Mint's fully owned by the Western Australian Government.
And does it mean because it's government, you can back them if they say they've put your money in gold? They've put your money in gold?
Well, not only have we put people's money in gold if that's what they've chosen to buy through us, but one of the unique features of the Mint is we have a government guarantee on the gold deposits essentially our clients have with us. So it's obviously a very important additional level of security that gives people, investors all around the world, comfort leaving metal with us.
Yeah. Tell us about all the main activities the Perth Mint does to generate business.
Sure, there's a handful of, I suppose, business lines that we're in. So obviously Australia is the second largest gold producer in the world. We produce the country produces around 300 tonnes a year. Perth Mint refines over 90% of that output. Yeah. So all the major Australian gold miners essentially send their gold to the Perth Mint, we refine it. Then we turn a lot of that gold into bars and coins, which we export to over 100 countries around the world and also sell in Australia. Yeah. And then the big area of growth, and probably the area that's of most interest to people that follow Switzer, is our depository and ETF solutions. So people can either buy and store gold with us directly, or in fact we've got an ETF or exchange traded product that sits on the ASX that people can buy very easily.
Now I would figure, particularly with inverted bond yield curves and the trade war stuff, the interest in gold has increased in recent times.
That's very true. So if you look at the year to September, gold price in Aussie dollars is up around 30%. Obviously very strong performance, up in all currencies, but in Aussie it's been particularly strong because we've had sort of 3 cash rates. We've had bond yields in Oz drop from, I think the 10 years dropped basically 60% in the last 12 months. Yep. So you've seen huge interest in gold. Probably the best way I can illustrate that is referred before to our Aussie ETF, the ticker code's PMGOLD, the inflows into that product around positive 45% year on year. So we've seen a huge uptick in demand from Australian investors.
Okay. So a lot of people will be surprised that you actually have an ETF. So tell us about the ETF.
Yeah, so it like most ETFs trades on the ASX. It is reclaimable or redeemable in gold, which is a bit of a unique feature. Most ETFs aren't easy to redeem in gold. Our product can be, but the most important thing for investors is the cost and the security of it. So, as I mentioned before, government guarantee to underpin the holdings of the ETF, and just as importantly, the management expense ratio of it is only 0.15%. So it's by some margin the cheapest way to get a gold price exposure through a listed gold ETF.
And I guess a question a lot of people would have is, if I go into GOLD, the ETF,
PMGOLD.
sorry, PMGOLD, and the gold price goes up by 10%, does it go up by approximately 10% minus any small fee they have to pay you guys?
That's exactly right.
Yeah.
So it tracks the price of gold in Australian dollars. It's unhedged, and it's actually very easy to, if you log onto the ASX, you can obviously type the ticker code into your screen.
Yeah.
You'll see the price. You could then go to the Perth Mint's website, and you can see just how easily it tracks the Australian dollar gold price. So, and it's been running for over 15 years. So there's an enormous track record for people to go back and essentially study that and see that it's performed in line with the Aussie dollar gold price.
It seems a lot less cumbersome than actually in the old days, which you guys still do. You buy the gold and bank it, or basically keep it at the Perth Mint.
Yeah, there's pros and cons to each approach, and it's not to say one is necessarily better than the other. I mean, a lot of people
talk us through them because people would be interested.
Yeah, absolutely. So to your point before, it was bars and coins that we still do, and people want delivered to them, or that they come and take from buy and take from the Perth Mint. Then you've got the direct depository offering. So that's where you trade directly with the Perth Mint, not via the ASX or any exchange. Now, the advantage of that is you can do not just gold, but silver and platinum, other metals. You can also have an account in US dollars. So for some particularly high net worth investors that like to trade in more than one currency, that's attractive. But certainly, if you look at, if I could sort of stereotype a little bit, the vast majority of, say, SMSF trustees who have already got a brokerage account and like trading via the ASX, then PMGOLD is a very easy way for them to incorporate gold into their portfolio. And as I say, with a management fee of just 0.15%, it's by some margin the cheapest way of them doing it.
Okay. Are there any other reasons why people buy gold?
I think there's a handful of reasons which are coming to the fore now. The number one is that, particularly in low interest rate environments, gold tends to perform very strongly. So we did a study of gold price returns from 1971 through to the end of 2018. And in the years where real rates of interest, so factoring in inflation as well, when real rates of interest were 2% or lower, the average return on gold in those calendar years was about plus 20%. And it makes sense, there's much less opportunity cost in terms of income that you're giving up. So that's reason one. Reason number two is it's proved to be a very strong diversifier and a hedge whenever equities are volatile. So again, over the same time period, if you look at months, quarters or years where the ASX has fallen, gold has tended to be the highest performing asset class, so it offers that defensive exposure. And I think another one that's becoming increasingly important to investors is the fact that it is low cost, the fact that it is liquid. It's easy to get into and out of gold. The gold market turns over about $100 billion a day. So there's a lot of reasons why people are putting, typically it's sort of 5 to 10% of their portfolio they might be allocating to gold.
Yeah. And I think, you guys and others like you have made it easier for people to actually get a bit of gold.
Absolutely right. Yeah, I mean, innovation in terms of the way we deliver the product to the market is incredibly important, and that's why we've done what we've done over the last few years with the products we've launched.
Yeah. When you're looking at those periods where interest rates were low and gold did well, they often come with, because you're an economist as well, so I'm sure you would have thought this through, and I'm just reacting to what you said. A lot of those times would have been after stock markets crash and recessions, were on, and of course interest rates always shrink to try and recover the economy, but people are so panicky, it just seems like gold is the most obvious choice.
That's right. So exactly spot on. It's not just the fact that rates are low, it's that the reason rates are low is because things aren't going tickety-boo.
Yeah.
So the sort of desire for investors to hold a sort of defensive safe haven only increases, and because gold supply is so stable, if demand increases, prices increase. It's as simple
And I
as
guess
that.
at the moment, Jordan, a lot of people are a bit, not probably panicky, but they're a bit concerned about what's going to happen next. And so gold could be a good place to be, just for security purposes. But if the worst case scenario goes, it probably will go for a rise. That's my best guess.
I think that's a really fair way of looking at it. So again, if we go back to why do people buy gold, and I suppose I talked a little bit about the portfolio reasons in terms of its performance in certain environments, but to your point, the main reason they buy it is wealth protection. If it happens to actually add some upside to their portfolio, then that's kind of the icing on the cake for most investors.
Yeah, okay. Tell me about someone with a self-managed super fund and why you think gold is increasingly being thought about as an asset, because usually it was stocks, bond funds, term deposits, maybe property.
Yeah, so I think it comes back to some of the reasons that we've already discussed in that, a lot of SMSFs are sitting on pretty meaningful cash allocations, and we're in an environment where the real return on that's kind of already negative and it's sort of getting worse. So gold sort of can be a bit of a solution in that sense. It also then acts as the hedge against their equity market exposure. And I think last but not least for SMSF trustees as well, is it also is an easy way of them effectively getting some foreign currency exposure in their portfolio as well. Because if the Aussie, obviously the Aussie's come down quite a bit over the last few years, may well be under pressure in years to come. Well, for an Aussie dollar investor, they will benefit from any decline in the value of the local currency. So those are certainly in the conversations that I have with direct SMSF trustees and indeed planners that service the SMSF market. That is, those are the key things that are driving the allocation to gold right now.
And I guess they could also take the US gold exchange rate as well, couldn't they?
They can, yeah, and certainly people that trade with us direct can buy and sell in US. But as I say, if I think of the sort of typical investor, they're generally happy to buy and sell in Aussie, and actually that currency exposure balances out their overall portfolio in a way.
Okay, so what's your view? Before I ask about the view for the outlook for gold, the trends you're seeing in terms of ETFs, bars and coins, what's showing up?
So I think the most obvious trend is the ETF market for gold is very strong. So globally, ETF holdings are incredibly, they're at all-time highs. They hit all-time highs in September of this year. And again, in Australia, it's particularly strong right now. So in the last 12 months, ETF holdings globally rose by about 20%. In Australia, as I said before, our product alone, inflows were just over 45%. So they're even stronger in Australia than they are locally. Than they are globally. So the ETF market for gold is very strong. Bar and coin demand is always going to be an important part of the gold market. And in terms of the other drivers of demand right now in the gold space, probably the most important one is the role of central banks. So central banks own well over 30,000 tonnes of gold. And in 2018, they bought comfortably over 500 tonnes. It was the largest single year of purchases since 1971. Since the start of the 1970s, and the first 6 months of this year, the numbers were even stronger again. So that's one of the things that's sort of obviously providing support to the gold market, and we suspect that that'll continue for some years.
Have you worked out why? Because you're an economist, and that's an interesting trend that because I think reserve banks or central banks were selling gold some time ago, weren't they?
They were. So central banks as a whole, there was sort of net sales from the mid-80s right up until essentially the start of the global financial crisis. And then for most of the last 10 years, they've basically been net buyers. And I think it's a case of wanting to diversify their foreign exchange reserves. So typically it was a case of, you could just put your money in US treasuries, short-term securities in the US, and in the sort of low yield or negative real yield environment we're in though, gold has again come back to the fore as a reserve asset.
Yeah, and central banks actually do make money, and governments then use that money as well, as we've seen locally. Finally, what's your outlook for gold?
My view is prices over the medium to long term are biased to the upside. We've obviously had a very strong move in the last 12 months, and so over the last few weeks we've seen prices sort of stabilise, which is a healthy thing for the market. But I think that as institutions, sovereign wealth funds, central banks continue to accumulate, and as more and more self-directed investors realise how easy it is to incorporate it into their portfolio, we'll see demand rise. And as I say, given the supply is so stable, you know, any increase in demand puts some upward pressure on prices.
And do you think the trend on the Aussie dollar will also be supportive of those people who hope that gold delivers some kind of capital gain?
Look, I think that if you consider that the market is currently expecting there'll be at least another interest rate cut in Australia at some point in 2020, and there's continued noise only at this stage around unconventional policy here in Oz, then in Australia, I think there's a good chance that, again, the Aussie's got some downside pressure on it.
A lot of people are talking 65.
Yeah. And so that's, again, it's a bit of an icing on the cake for the gold story, I think, for a local investor.
Jordan, thanks for joining us.
Pleasure, Peter. Thanks for having me.
So that's gold in the spotlight and some very interesting issues. I think everybody would like to invest in China, but they're a bit afraid at the moment because of the Trump trade war and the implications of it. But certainly, given the fact that the Chinese stock market has been negatively affected by the trade war, if a deal comes along, you expect a nice big bounce for Chinese stocks. One way to invest is to go through a company that's a fund manager that operates in the space. Now, Catherine Yung is Investment Equities Director for Fidelity in Hong Kong. And I'm going to catch up with her now to find out what's going on there when it comes to investing in China. And is it probably better or even worth considering doing it through a fund manager? Catherine, thanks for joining us.
Nice to be here, Peter.
Tell us about your role at Fidelity International.
So I'm an investment director. So I sit within the investment team alongside our portfolio managers, mainly represent our China portfolio managers. And my responsibility across channels and geographies is to talk to our clients, the press, about our views and portfolio strategy.
Yeah. Do you tend to direct your portfolio managers, or are you the objective set of eyes? You challenge them, test them on their views, or you just cop whatever they say?
No, that's our CIO who advises, and mainly our CIO or head of equities. Now I work alongside them, and it's really to get the messaging and the position of the strategies out to clients.
Yeah, and that's a really important thing.
It is important.
Because particularly when they take a bold move, which people don't agree with, the clients need to have someone to actually, tell the story.
Yeah.
So what is the story you're telling right now?
So Asia's pretty unloved across global portfolios, but we still think there are a number of interesting opportunities, particularly when it comes to the Chinese landscape and the Chinese market.
Okay. Now, I know with a lot of our financial planning clients, we're saying, well, if you really needed to make money, I would get you to expose yourself to China on the basis if a trade deal comes along, they're probably about both in the US and in China. But if you don't need to, let's sit and wait and we'll miss the first 5% and jump on board. Do you think the trade deal is going to be important to give the Chinese stock market a lift, or can lift even without a trade deal?
Well, it's really sentiment driven, and this trade discussion, all these discussions between the United States and China has gone on for close to 2 years now, isn't it? So it's this overhang. But it's interesting, if we use the S&P 500 as a proxy, that first sort of disagreement in September last year, the market was down about 20%. Then in May this year, the second disagreement, the market was down about 7%. In August, down 6%. So it's almost being priced in, and perhaps the rationale is that the Federal Reserve will help underpin economic growth by cutting rates, that multinationals are diversifying some of their manufacturing away from China. But even if we do see this short-term resolution when it comes to the tariffs part of the discussion, the relationship between the United States and China has changed.
Okay, so ultimately then, somewhere down the track, stability will be established.
Hopefully.
Hopefully. I was waiting for you to throw that one in. But are a lot of companies holding back their investment?
They are.
Because they just don't know what's going on.
You know, it got to a point last year where some of the companies were saying, we just don't know whether President Trump will tweet about us. So whilst we have cash on our balance sheet, as you rightly pointed out, we're not willing to reinvest because we don't know about demand. And as a result, the Chinese government have really looked at easing or tweaking, especially from a fiscal perspective. And in fairness, the regulators and the policymakers do have the tools to ease and increase sentiment positively. But you mentioned the word stability. It's quite interesting, Peter, because when we look at high frequency word searches across any senior government official speech in China, the word that comes up the most is stability.
Okay. So let's just assume there will be some kind of deal, phase one, and hopefully phase two and phase three come along the way. But this has led it up, because to me, it seems to be something over the next year before an election. And it may well kick off again if he wins the election. But if someone wants to make money investing in China, if they took a 3-year view, do you think that there's enough internal forces and changes within China that are going to create lots of opportunities for your funds to make money over time?
Definitely.
Yeah.
And it's interesting, this new norm that we're living in terms of the relationship between the US and China. Essentially, it's Make America Great Again versus the Made in China 2025 strategy. And the 2025 strategy is essentially the Chinese government supporting, even financially, companies climbing up the value chain. And this is the problem, or this is sort of the catalyst for this changing relationship. So if you think about it, Apple and Huawei, Amazon and Alibaba, most of their sales are derived from their own domestic markets.
Yeah.
But what about the rest of the world? And these companies are now competing for market share globally. And so the relationship has become a lot less cooperative between the two economies, a lot more competitive. And what I think is fascinating in terms of investment opportunities, Chinese companies have become so innovative. Their R&D is amazing. And they really are, in fact, climbing up the value chain. And this is one area that investors can really take or participate in.
Now, I interviewed the head of Alibaba Australia yesterday. And I was quite staggered the amount of Australians who are actually buying stuff on Alibaba, but also selling stuff on Alibaba as well, because the Chinese really like Western products, and that's a real opportunity for lots of small to medium-sized businesses with interesting products.
Yes, especially food-related products. Organics very important in terms of international imports for the Chinese consumers. But at the same time, a fascinating dynamic is occurring in China, and that is Chinese brands now really increasing their presence and tapping into their own markets. So manufacturers historically who would do stuff for international brands are creating China-only brands. There's a really interesting name called Li Ning. I don't know whether you've heard of it. It's named after the famous gymnast.
Yeah, and he has a sports store.
Yes.
In fact, your colleague Anthony Doyle talked about at one of our conferences.
Yes. But what Li Ning did a couple of years ago is a classic turnaround story in terms of investment strategy. They hired top-end designers, and they've created this brand called China Li Ning. And you can only buy it in China. And it's streetwear or activewear, which basically modernizes what Li Ning the gymnast wore in the 80s. And it's really high quality. They showed it on the runways in Paris and in New York, so it was written up in Vogue. The margins are a lot higher than the Li Ning broad-based brand. And the company's seen a massive turnaround. And because they're not copying the designs of Adidas or Nike, they're really making the Chinese brand accessible and almost appealing for Chinese consumers.
And it's taking away from the Chinese preoccupation with American brands as well, which a lot of young people are committed to.
Yes.
Yeah.
And a lot of companies also, e-commerce companies, service-related companies, their brand power is increasing, and the Chinese companies are saying because they understand the Chinese consumer.
Okay, and I know the argument is that China wants to reduce its growth from exports and starting to self-generate growth by building up the Chinese consumer.
Yes.
Is that happening?
Yes.
And is there a lot of upside to that story?
This is such a multi-decade theme that we're seeing. So, for example, Alibaba, they've now entered the space of the rural consumption market. So there are technically 600 million rural consumers. That's not the lower tiered city consumers.
Right.
And they behave in a different way to your urban consumer. It's all about the pricing point, not so much about the quality. Now, 60% of this theme has already been penetrated, so at least 40%. So that's maybe another few years. But then what happens? The rural consumers, like their urban counterparts, start the premiumization story. So instead of buying packet noodles, bowl noodles. And this premiumization story is definitely occurring, whether it's in the auto sector, fashion, and then consumer, like food, goods, staples.
What I think we've touched on what could go right over time. Is there anything else that you would throw into the mix to justify your excessive optimism about investing in China over the next 3 years, which I'm kind of on a unity ticket with you, but I just wanted to hear what you have to say about it. Is there any other force that's going to make this story even more believable? Not that it's not believable, but even more believable.
Well, there are still risks, and we can talk about the risks, but another key area alongside the Made in China 2025 strategy, the Belt Road Initiative, is the opening up of China's capital markets. And as you see more stocks which are listed in Shenzhen, on the exchange there, Shanghai, we now have our own sort of NASDAQ board, which is called the STAR board, so Science, Technology, Innovation Board. When you see all this opening up and the fact that these Chinese stocks are being incorporated in global indices, whether it's FTSE, MSCI, it's now starting to be more representative of what we're seeing on the economic and political landscape. Right. So foreigners are definitely going to look more at China and represented in their portfolios.
Okay. So apart from positive internal forces, do you think there's going to be even more positive external forces helping the Chinese economy and its stocks and all that sort of stuff head in the right direction?
Well, what is key for China, and I know this is very contrarian because most people go, China, if I'm to enter the market, I want to buy Alibaba or a consumer related name.
Tencent.
Yes, and they're great names. But what investors are ignoring, which is probably going to be a long-term positive trend for the Chinese market, is the focus on income. Australians love income, but what we are seeing through the regulators, because of improving corporate governance guidelines, are the state-owned enterprises, we call them SOEs, increasing their cash on their balance sheets and then rewarding minority shareholders through higher payouts and higher dividend yields.
Okay.
And you wouldn't associate China with dividend yield, but it's actually becoming more and more of a focus point.
It does make sense because in Japan they love income so much they'll take like 0.5% at the postal. It's the
GPIF.
Yeah, well, it's like basically the postal savings bank, isn't it?
Yeah.
And interest rates have always been ridiculously low, but they put their money there.
Yeah, but the Chinese income story is important for two reasons. One, you're improving the quality of the management teams. Yeah. So this is good for foreign investors who, even if they don't want to go into China because of the change in the indices, like from a passive perspective, are adding more China. But it's really, really important for the domestic investor base. Now, with this urbanization theme, higher incomes, and that's part of the reason why some manufacturers have diversified, because incomes are higher than, let's say, Vietnam, from a manufacturing perspective and a cost perspective. If you are a family and you're receiving more income, and let's say, as you rightly pointed out, the government wants the consumer and the services sector to drive GDP, we need to see that savings rate of 37% come down. It's only going to come down if, as a household, you feel secure in releasing some of those savings because of a better pension system, a better healthcare system. So let's say the Chinese incorporate a type of superannuation system into the country. That's income or capital. Where's it going to go? Because at the moment, you've got two choices. Cash, which is relatively low, like the rest of the world in terms of the interest rate you receive, or property. And the property market, as President Xi Jinping keeps on reiterating, you live in a place. It's not for speculative activity. So if you now have like an Australian domestic investor, equities as a long-term investment or asset allocation, then you want to look at the total return strategy, i.e. the income side. And so historically, Chinese mainland investors have been very short-term, momentum-driven.
Yeah, speculators.
Yeah, and now if they look at equities like domestic families in Australia do, then it will change the makeup of the investor base in the market. And again, this is really positive for foreign investors.
Okay. So the downsides, what are the risks going forward, do you think?
Policy mishap. It all relates back to policy. And I think what's really key to understand in China is there is this policy line that moves up and down. You can't be too far away in terms of a company because you don't reap the benefits, and you certainly can't cross the policy line. So policy mishap, the tweaking of policy in terms of fiscal, monetary, that's good. But if we were to see another big stimulus plan like the global financial crisis, that's probably a bit of a red flag because China still has some debt that they need to sort out.
Okay, so let's imagine that we've enthused the current non-Chinese investor with this great little chat between you and me. What's the best fidelity fund to give yourself exposure to this great story?
Well, it depends whether you want just a country exposure or regional exposure.
I think country.
Okay, country, then I still think our Fidelity China Fund makes a lot of sense.
Gee, that's a good name, the Fidelity China Fund.
Yes, well...
Who could forget
I
that?
know, it says what it does.
Okay.
She's a value contrarian portfolio manager or investor, Jingming, which is incredibly unusual because, as we've been talking about, most people who like the growth story or the growth angle of China. So she believes she can find value in every sector. So value investing in China isn't like value investing here, where you buy utility companies, etc. And her performance over the long term, she underperforms in high growth periods, and it's been a very crowded trade market this year, up until recently, where we're seeing a bit of a mean reversion. But she really gives you that broad-based exposure to the China story.
Okay. Now, if you didn't want to go that, what's another fund that if we want two? One is a contrarian. Is there one that plays the momentum for China?
Well, there's our regional fund that's managed by Anthony Strom, who's actually Australian, but he's based in our
We
Singapore.
won't hold that against him.
No, we won't. He's based in our Singapore office.
Yeah.
And he is also a bit different in terms of his peer group. So he's regional, but he's very, very concentrated. So between 20 to 30 names. And for example, one of the best performing names in his portfolio is in fact a Chinese company called Kweichow Moutai. You've probably heard
Household
of it.
name, isn't it?
Well, it's beginning to advertise a lot in Australia, isn't
Okay.
it? The billboards at the airport in Sydney.
Oh yes, I see that.
Yeah, it's Baijiu. Baijiu is a little bit like, it's very, very strong liquor. And it's the champagne of China. It's got first mover advantage, that premiumization story, the upgrading that I mentioned. It's really benefited from that. Huge demand. It even ran out of supply one year during Chinese New Year. And that name has performed incredibly well.
Okay, so what's the name of that fund?
That's the Fidelity Asia Fund.
Another
Says what
easy
it does.
one. Okay, thanks for joining us.
Thanks
Catherine.
so much, Peter.
That's Catherine Yung from Fidelity.